This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios, getting into the week, so as to speak, Tuesday morning today. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, good morning.
Morning.
Hi, good morning, Prashant. Good morning, Nigel. I think, largely this market has been a bit under pressure. There's a little bit of a sell-on rally. So let's see if things change today, because the global cues were not too bad. But the GIFT Nifty is suggesting otherwise.
Yeah, no, I mean, the problem is not stocks so much. It's what's happening to the dollar, what's happening to the yields, and I think that's what will take away a lot of attention today as well. And actually, and that's precisely the reason I'm not going to start with equity. Usually we start with what the Nasdaq did, what the S&P did, but that's not the real story. Anyway, rewind back and just start by telling you the close yesterday, which is interesting. The Nifty yesterday took support exactly at the 61.8% retracement of the rise from the end of August to the middle of September. That's 31st of August to the 15th of September. The 61.8, the golden retracement, is comes in at 19,605. Guess what yesterday's low was? 19,601. So pretty much there, right? And then the market bounced. It was inconclusive. We ended in the middle of the range, but that support came in. Now, I'll come back to levels after I've told you what cues from overnight look like. The big story from last night is the rally in the longer end of the Treasury curve in the US, yield curve. So, we saw a 10 basis point jump in the 10-year US Treasury yield, and now we are past the 4.5% level, right? This is quite incredible. 4.55 is an important resistance. Without going into detail, that's basically where it should slow down. And by the way, I mean, if you looked at last night's session and this 10 basis point move higher, it did look like going to the highs of the day past 4.5%. The momentum was flagging a little bit. So hopefully around 4.5, 4.55 odd percent, things start to fizzle out. That's the hope. Now, we'll have to wait to see if it actually happens. Dollar index hit a new YTD high, year-to-date high. And that's now closer to 106, the dollar index, that is. That's against a basket of currencies. And that's basically following what's happening in the US yields out there. And the third item, which has been of worry, the trioca, so as to speak, as we've highlighted for a while now, oil prices, they didn't move up or anything, I mean, substantially, but they're still closer to $94 a barrel. I mean, prices on oil are up, they're up. Oil is up 30% since where it was in June. So we've seen a very large move higher. There was also, some Fed speak. The gentleman from the Federal Reserve who spoke is traditionally considered a dove, which is, he's not, he kind of leans on taking it a little easy, not hiking too much, etc. But he basically reiterated the higher for longer narrative. He basically said that the conversation and the sort of chatter around Fed meetings will shift to not how high rates need to go, but for how long rates need to be held at a high level. And I think that kind of reinforces this higher for longer narrative. Markets, especially bond markets, paid attention to it. Now I'll come to equities. I mean, they're flattish, right? I mean, the S&P 500 was up about 0.4%. The Nasdaq was up about just under 0.5% or so. So, I mean, those changes, those closes are not bad at all. But as I said, the worry is what's happening on the rate side. Now, coming to the levels here, just to tie all of this in, I'll start with what I began, which is the fact that 19,605, the level at which the Nifty took support, becomes important. That's a 61.8% retracement. Hopefully this will hold, right? Hopefully. And I don't want to preempt it, but yesterday it did seem like the first instance of downside momentum starting to fade a little bit in terms of stocks, in terms of indices, etc. So we'll see. The immediate resistance on the upside will come at the high, yesterday's high of 19,734. By the way, that also coincides with the 20-day moving average. Not exactly. It's about the 20-day is about 10 points lower at about 19,721, 22 or so. But around that level is where I think the market will find some selling pressure, some resistance, which will come in. Bank Nifty saw a positive daily close yesterday. Even on Friday, the previous trading session, the banks outperformed the Nifty. It ended flat while the Nifty was down sharply. We need to watch if yesterday's low of 44,400 will hold. So that's about 300, 350 points away from where we are. And on the way up, the resistance is the 20-day moving average, which comes in at 44,990. And above 44,990, the immediate next level is the 38.2% retracement of the fall, not the rise, but the fall from the 15th of September high to the recent low. So the recent last 7-8 days fall, which comes in after the 20-day at 45,130. Again, I mean, these levels are not very far away, but I mean, we're living day to day because arguably the texture of the market has changed a little bit over the last couple of days from trying to buy every dip and trying to chase momentum higher to being a little cautious, being a little on the sidelines. I said this yesterday, don't go in right at the word go. That worked out well yesterday, and I'd repeat that till, I mean, this sort of, phase in the market clarifies and prices tell you what they want to do. The GIFT Nifty is indicating a 50-odd point lower start. Sonia.
Oh, absolutely. And this has been a sell-on rally market for the last few days, right? And I think that's a texture that could continue even over the next couple of days, given the kind of cues that we have stacked up. It's a choppy market that we have on our hands, and that's largely because of the volatile global cues. So just to add on, this morning, in fact, the Asian markets are under pressure. Almost all Asian markets are trading in the red. The S&P 500 and the Nasdaq ended their 4-day losing streak, but the GIFT Nifty is suggesting that the start will be in the red as well. Now, let's not forget that the Nifty, if you just map the last, 10 days or so, the Nifty is actually down 2.5% from the highs that we saw of 20,192 on the 15th of September. So we've lost a bit of ground in the last many days. And large quantities of selling from FII seems to be the primary concern now. Of course, along with other issues like higher Brent crude prices as well as, higher rates for longer in the US. But look at the FII numbers. Yesterday, FII sold about 2,330 crores. And put together in September so far, FIIs have sold in excess of 20,600 crores. So that continues to be the biggest concern that the market has at the moment. So as we were saying, a sell-on rally is something that can continue perhaps. And two more headwinds, which is Brent. Despite a little bit of a cool-off in the last 24 hours, Brent is still above $93 a barrel. And of course, higher interest rates for longer, that the Fed has said that's something that, could put a lid on the market's gains in the very near term. Watching out for a lot of stocks that have been under pressure, especially large caps like HDFC Bank. More on that later. But for now, I think, GIFT Nifty is suggesting that once again, the bulls could be on the back foot this morning.
Well, Sonia, with regard to yesterday's trading session and Test cricket parlance, I don't know how many times you've seen a batsman bats the full day and doesn't score a single run. Yesterday, at the end of it, the Nifty was virtually unmoved. And though we had a swing of 50 points in either which direction. So the Nifty didn't move yesterday. But today, in fact, the GIFT Nifty is suggesting that it pulls back closer on 40, 50 points to kickstart trade. I think the problem is that on a day-to-day basis, you're seeing that the Nifty is making lower lows. In the last 5 days, if you pull it up, yes, that's the chart we're talking about. Last 5 days on a day-to-day basis are making lower lows, which is a bit of a worry. And technically speaking, that indicates that there is some weakness in the market. The FIs, well, in the futures market, they've turned net short. And this is the first time in this series and the first time since 30th of August that they're net short on the index, because yesterday they added close to on 15,000 contracts on the short side. I wouldn't view this very, very badly, actually, because, if the FIs are net short, plenty of bad news coming in there, some kind of good news from somewhere. And if we can hold on to that maybe 19,500 odd mark, that could be the reason that we bounce back. The problem today is that global cues itself are in a bit of a tizzy. So you need to see global cues first that stabilize. And from being net long with 60,000 long contracts, now you're down to a negative number. That is, now you're net short with 3,500 contracts on the short side. Short point, FIs have turned net short. Moving to the options data then, 19,700 call. Yesterday, the premium was around 100 rupees. It ended at around 75 rupees. Fair bit of writing was seen at those levels. So that's giving you your resistance level. For those that are writing that strike, they look at 19,800, 19,850 holding out. So that's the resistance level. Yesterday's low was 19,602. So that becomes the first level of support according to me. And going by the GIFT Nifty rate, we'll be starting closer to those levels. Today, we'll also be watching the Nifty Financial Services Index because that plays out expiry. And there was a fair bit of action at the 19,800 put yesterday. So the 19,750 level becomes crucial on the Nifty Financial Services, particularly in the last hour of trade. You could see some volatility. By the way, yesterday that index was outperforming, so keep an eye out on that. GIFT Nifty pulling back close to around 50 points, starting near the crucial support zone. Let's see if the bulls can fight yet again from here. And as Sonia said, I think HDFC Bank, that will play a key role from here on.
Absolutely. And, lots of other stocks in focus. So let's get to it very quickly. First up, we have some views coming in from Sunil Tirumalai of UBS, who says that India is trading at an all-time high 80% premium. He says this represents the premium that stocks in India are enjoying versus the emerging market universe purely because they are listed in India. He says the richness is also visible in the all-time high small cap valuation premium to large caps. He says they stay cautious on India and continue to like banks and industrials.
Okay, some money market views. This is Kunal Sadani of Shinhan Bank, who says that the US dollar trades higher as the risk of US government shutting down escalates. He says the 10-year treasury yields touched a 16-year high while the dollar index hit 106 levels last seen in November of 2022. He says US Fed speakers continue to remain hawkish. For the USD INR, 82.95 should act as a support, while 83.3 is the resistance.
All right, and on the bonds, Ajay Magnolia of JM Financial says that as major central banks advocate higher for longer rates, global bond yields continue to head north with the US 10-year yield at over a multi-year high. He says the buoyancy led by index inclusion was short-lived and it looks tough for any rally in the near term. He adds in the absence of any cues for the day, he expects the new 10-year benchmark bond yield to trade in a range of 7.13 to 7.18%.
Well, we've got a lot of stocks that we're tracking for you. We get to that in just a bit. But for the time being, let's run you through the top list that we're tracking in our special top 10 segment. We're looking at Tata Steel, Strides Pharma, Greenply Industries, DB Realty, Apar Industries, Salzer Technologies. We have Welspun Corp and Fortis Health. All of them on the back of positive news flow, while two stocks will be reacting to negative news flow. One is Voltam Transformers, where the promoter entity is looking to take some money off the table, and GR Infra Projects as well.
Okay, well, the big exclusive interview of the day. JP Morgan Chase Chairman and CEO Jamie Dimon says geopolitics is the #1 risk the world is facing today. In a freewheeling chat with my colleague Shireen Bhan on the sidelines of the JP Morgan India Investor Summit, Dimon spoke on a range of issues from India and US partnership and the AI opportunity. Listen in.
The pandemic started to wake everybody up, and then Ukraine accelerated this wake-up call, so to speak. What are the long-term implications of what you're seeing play out as foreign policy changes, as national security weighs on economic and government decisions? The U.S. is rolling out the CHIPS Act, for instance. India is trying to partner with the U.S. to ensure that we have a partnership as far as chips are concerned. How do you see this impacting flows? How do you see it impacting globalization moving forward?
Yeah, I think it's just going to change it. So I don't think it's going to, people say decoupling, there's still globalization. The nations are going to have, companies and nations are going to be making determinations which change those flows. That creates huge opportunity, I think huge opportunity for India, for services and certain manufacturing, and it creates risks. So I'm hoping that political leaders sit down, have these conversations, and make these changes in a way that's not completely disruptive, but is dwarfed by the risk of war and nuclear proliferation and things like that. So I think we have to be very cautious about it, but it's an opportunity for India, and hopefully you're going to seize it. I also think, by the way, it's affecting global relationships. India and America are natural partners. Now you have to be, you're here, so you're between Russia and China, you have to be kind of non-aligned, but we're your best friend. I mean, anyone who doesn't think that through hasn't thought really carefully.
Yes, we can see that. I mean, there's been a lot of back and forth between President Biden and Prime Minister Modi.
And I'm thrilled that they're having those conversations. And I think we've got to do a better job on the trade and investment side.
Okay.
Not just the labor and climate side.
When you say better job on the trade and investment side, what do you mean?
That we should sit down with India and negotiate better trade and investment relationships to open up more markets to both sides. India can let some more competition in here. We can bring in more capital and both of it. So I remember talking to some Indians, after some of those negotiations. It's really great, but what about trade? Right.
Yeah,
you like us a lot, but what about trade?
Fair enough.
Right.
But, since you were talking about risks, let's talk about what's happening as far as the U.S. is concerned. And I was having a conversation with Larry Summers over the weekend, and he says, look, he doesn't believe that higher for longer is necessarily going to be anti-growth, because it fundamentally underlines the resilience that the economy seems to have. Yeah. But you've been cautioning everybody about don't just focus on today, but worry about tomorrow. So what does tomorrow look like?
Well, so I agree with Larry, but he also is quite concerned about it. So if you have higher for longer, but you've got good growth and inflation is kind of contained, that's good. You just have more fighting for capital and people paying up for capital, and the world needs it. It needs it for remilitarization, the green economy, the IRA Act, the CHIPS Act, huge deficit spending, but we need growth. If you actually have stagflation, that's not so good. So I just say, right now it feels good. That fiscal stimulation was extraordinary. The monetary stimulus was extraordinary. That was a global phenomenon, more in the United States and elsewhere. But that's a little bit of a sugar high. And that's a little bit going to go away. And we're hoping we have a soft landing. But all these other things are there. QT, Ukraine, oil, gas this winter, disruption of trade flows. So, I think good leadership on the part of, America, India, China, Europe can make sure the negatives don't happen. But I'm putting myself in the quite cautious category.
In the cautious category, and you just talked about the spending, and I remember you said that we've been spending like drunken sailors. So as the party starts to wind down and tightening happens and interest rates continue to remain higher, what do you believe are likely to be the adverse shocks that the world is going to have to deal with? Debt, of course, is the big one, and the debt burden, large continents like Africa dealing with that at this point in time. What will it mean for things like climate transition and the many other SDG goals that we have?
Yeah, I think we got to not get confused around various goals. Unbelievable debt financing and high levels of debt around the world. We don't know the effect of that. And these deficits, other than war, have probably been as high as they've ever been. And like I said, with the highest debt level already. So I put that in the little sugar high category. Government spending is inflationary. Governments can't just simply spend more and more money and think it's not inflationary. But I don't know the effects of that. I mean, like I said, we can have higher rates, a slowdown, but inflation coming down and good growth.
Do you see another rate hike, though?
I think it's more likely than not. But, again, I think people should be prepared for higher oil and gas prices, higher rates, as a matter of just being prepared. You and I can guess what it's going to be. You don't know. I don't know. No one knows. But I think the odds are higher than that. And so, but hopefully we'll get to that. I think the geopolitical situation is the thing that most concerns me. And we don't know the effect of that in the economy. And so but again, I think that the humanitarian part, that's far more important. I think it's also very important for the future of the free democratic world. We may be at an inflection point for the free democratic world. That's how seriously I take it.
So geopolitics, the number one risk that you believe the world is facing today?
Absolutely. We've dealt with inflation before. We've dealt with deficits before. We've dealt with recessions before. We haven't really seen something like this pretty much since World War II.
Yeah, so we don't have a playbook for this just yet.
There is no playbook.
Yeah, and so we don't know what the intended and the unintended consequences of this will be. But let's talk about the banking sector in the US, and especially after the crisis. We hope that it's behind us at this point in time. You're not particularly happy with the way that the regulator has decided to move and bring in norms as far as capital is concerned, and you believe that there should be more transparency in being able to deal with this. What are the implications of those proposals going through?
I don't know. I mean, I think that is a great question. Like, one of the things I think should take place is, what do the regulators want? Do they want the mortgage business inside banks or outside? Do they want credit outside the banks or inside? Do they want diversification or no diversification? So like some of these rules are anti-diversification, operating risk capital, G-SIFI. Do you want American banks to have the same requirements as international banks? Because right now it's 30% more. And there should be cost-benefit analysis, transparency, what we're trying to accomplish. And and I hated to do that. Everyone's going to be yelling and screaming at each other. I wish that work was done beforehand. Now it'll probably take place, and we'll see. They're going to do what they want to do. J.P. Morgan can't affect that. They'll hear. Everyone's going to put in their comments, and hopefully we end up in a good place.
My last question to you, AI, and you believe that AI is going to be driving J.P. Morgan's future as well. It's critical to each aspect of your business. What are you doing about it?
Yeah, we have 1,000 people involved in it. AI is as real as they say. We have 300 use cases around marketing, fraud, risk. When we move $10 trillion a day, it's going through AI systems. Every application, every job, every person will be affected. And remember, bad guys can use it too. So we have to be ahead of the bad guys in terms of voice recognition, how they use data to get, and even for cyber. And it's going to be great for mankind. There may be some disruption. I think governments should be prepared to deal with the disruption, but they can't stop AI. And the other thing about AI, it could be around the world, and bad guys can use it too. So probably a very big plus for mankind, but I completely understand people's concerns about the bad side of it.
Okay, so the geopolitical concern is the biggest concern that Jamie Dimon has. Very interesting discussion over there. You can catch excerpts of that exclusive conversation with Jamie Dimon all day today on CNBC TV18. Let's take a quick break on that note, but on the other side of the break, our entire research team will help us analyze all the top stocks that you need to watch out for as we head into a brand new day of trade. Stay tuned.
So far, so good. Clearly, we've got a long way to go. We're 18 year or so into a 5-year journey, but it's a good start.
The first 6 months were the taxi phase. You're now in the takeoff phase. Have you taken off?
Takeoff requires a takeoff roll. We're halfway through that 12-month phase, so I'd say we're still on the runway, but we're getting close to, in our parlance, V1. 6 new wide bodies are in the fleet already, 5 more 777s coming in over the next 5 months. We're in the process right now of taking legal delivery of the first A350s. Next week we should take legal ownership of our first 737s. From a human resource perspective, we've completed the VRS phase. We've ingested a lot of new people into the business with new skills, new thinking, external perspective. Anything that is subjective is going to draw opinion and comment, and that's perfectly fine. I mean, in some respects, I feel like the captain of the Indian cricket team, that there's 1.3 billion opinions on what we do, just as there is on what he does.
And speaking of your innings as well, do you feel more like a T20 captain or a Test captain?
Maybe we're graduating nearly to an ODI.
Welcome back. This morning, the GIFT Nifty is suggesting a slightly weakish start, so down almost about 50 odd points. But we'll take it from there. Our research team is standing by to give you the list of top stocks you need to watch out for the day. And there's a lot of news flow on metal stocks, especially on Tata Steel. So Nigel's going to tell us about that. Nigel, over to you.
Well, the overnight news actually on metals is a little bit subdued, but there is some good news coming in for Tata Steel, so we'll address that. Moody's, they've upgraded Tata Steel to investment grade. They've given the outlook as well as stable. The upgrade reflects the expectation of continued strength in credit due to its solid market position, particularly in India. They expect the profitability to increase, though steel prices are a little bit softer, and that's what's going to weigh on the revenues. But because they're backward integrated, they believe that things will still look up for them. And they've also taken note of the deleveraging plans. So they expect debt to pretty much remain in control. Put all these factors together, Moody's, they've upgraded their rating on the stock. And let's see how it reacts. Though overnight, we have seen that steel prices, iron ore prices, coking coal cost, all of them are a little bit lower. But late in trade yesterday, we had the Strides Pharma deal that was announced. And the street liked it because the stock ended at the high point of the day. Ekta has heard out the con call as well. She's joining in to fill us in with further details. Ekta?
Yes, thanks for that, Nigel. Well, yes, the Strides call took place at 5 p.m. last evening. A couple of interesting takeaways. Now, the combined business, which is the CDMO business, which they are looking to integrate across their entities, they have said that the FY24 guidance is $145 million with 25% margins for the CDMO business. For FY25, the guidance is around $200 million with 30% margins. They expect Stelis to probably add $5 to $6 million of EBITDA in FY25. That's important because it is just about breaking even. Now, they say that there is strong visibility for the CDMO business when it comes to diabetes molecules such as GLP-1. Because of these factors, they believe there are no challenges in the business doubling from $200 million in FY25 in less than 3 to 4 years. Longer term estimates is 25% growth for Stelis. They're expecting to reduce debt as well. So because of these reasons, I expect follow-on buying coming in on Strides.
Okay, Ekta, thanks very much for that. So that's an important news flow. We will get back to with more in a bit. But Voltam Transformers is the other one which is in focus. There is, a block which is expected. Vivek is joining in. This is something which our colleague Nimesh had highlighted on D Street Chatter a couple of days back as well. But Vivek, take it away. Good morning.
Well, good morning. That's right. Nimish too had highlighted this on D Street, and Sosu also tells CNBC Awaz that the block deal is likely to happen in today's trading session. The promoters are looking to sell up to 12 lakh shares. That is more than 10% of the total equity of the company. Now, this particular deal size is more than 550 crores, so it's a large deal size that's expected to happen today. The floor price for this particular block is at close to 4,600 rupees a share, indicating almost a 7% discount to the current market price. Avendus Spark is said to be the broker to this particular block deal.
All right, thanks a lot for that. Mangalam is also joining in. He has a couple of stocks that are in the news this morning. Mangalam, what's on your list?
Well, I have Greenply, where they partially resumed their operations at the Gabon facility. Remember, this was a fair amount of back and forth out there. So now that there has been partial resumption, see it slightly in the positive light. DB Realty is the other one. They've announced investment of nearly 2,300 odd crores in hospitality assets. A lot of the real estate players are now looking at hospitality as an important investment arena. So this is a mild positive for them as well. And Apar Industries, the board will meet on September 28th to consider a fundraise. So that should be a positive for them as well. So all three stocks are likely to be in the green.
Okay, all right. Thanks a lot for that, Mangalam. Well, let's hop across to Surbhi. She's here to tell us about some more stocks that are in the news. Surbhi?
So first one on my radar is GR Infra Projects. Now they had bid for two ropeway projects back in February, which have been now annulled by the National Highway Logistics Management. The total project cost was 3,600 odd crores, so that could be in the red today. Salazar Techno, they've commissioned a zinc galvanization plant with an annual capacity of 96,000 metric tons in UP. Welspun Corp, the company's wholly owned subsidiary, has entered into an MOU with the Telangana government to set up a manufacturing unit. Now, this manufacturing unit will manufacture water tanks and pipes. The investment is about 350 crores over a period of next 3 fiscals. And lastly, Fortis Health is also on my radar. The acquisition structure of artistry properties has now been reworked. The company will now acquire the company directly versus acquiring assets and license in the company earlier, and they will acquire 99.9% stake for an enterprise value of 32 crores.
Okay, thanks a lot for that. So lots of stocks in focus actually. So let's do a quick recap in case you missed out on any of them. Stocks with positive news flow, there's Tata Steel, Strides Pharma, Greenply Industries, DB Realty, Apar Industries, Salazar Technology, Welspun Corp and Fortis Healthcare. While stocks with negative news flow, there's Voltam Transformers and GR Infra Projects. But the other big headwind for our market has been the rise in crude. Despite a mild moderation overnight, Brent crude prices are still above $93 a barrel. Manisha Gupta is joining in for a roundup of all the action that we got in the commodity market. Manisha, good morning.
Morning, Sonia. Thank you for that. Well, yes, still holding around that $90 and $93 a barrel mark, even as the dollar index is now at a 10-month high, and that has put pressure across asset classes. But the crude oil prices have been able to hold on a firmer note here. Here as well, when you look at the hedge fund bullish bets on crude, they are at Feb 2022 highs. So that does tell you that the smart money is still invested in case of crude prices. What with most Wall Street banks suggesting that the crude prices can be in 3 digits in 2024 itself. Markets also will watch out for Russia, which now says that the fuel export ban is going to be less severe. The U.S. debt ceiling crisis still continues to weigh, and many of these banks and brokerages have now downgraded China GDP. So those are some of the factors keeping the crude prices in check. But the metal scenario is not any different. You are looking at pressure here as well. The Chinese demand from construction and manufacturing is on the weaker side. And remember, China is going for a Golden Week holiday that starts from this Sunday itself. So that demand from China also would be absent in the next week. So some pressure is what we've seen in metals because of that.
Okay, well, Manisha, thank you very much for that. So that's basically the commodities action as as it's unfolding. We'll take a quick commercial break here. Himang Jani will join in for a quick fundamental stock check. We'll also connect with a couple of cement players because the buzz is that prices are looking up, especially in the south of the country. We'll have the management of Kesoram Industries join in, and also we'll have Naveen Saidyo, analyst at ICICI Securities, who tracks that space, come in with the discussion. Stay with us.
Welcome back to Bazaar Morning Call. We have plenty of stocks in focus, so let's get straight to it. Market expert Hemang Jani is joining us. And one of the stocks that I'm looking at this morning is HDFC Bank. Now, if you map the chart of HDFC Bank, in the last 5 trading days, the stock is down almost 8%. So it's been under a lot of pressure. And yesterday, though, we saw the first signs of delivery-based buying in HDFC Bank. So that is an indication. I mean, is there a turnaround coming through? There was large delivery volumes of over 3,070 crores of buying is what we saw in HDFC Bank yesterday. So, of course, the market needs HDFC Bank to, support it for that recovery to happen as well. So, let's get Hemang into this discussion. Hemang, I wanted your thoughts here. At this 1530 price, is the risk-reward favorable in a stock like HDFC Bank?
Yeah, good morning, Sonia. So HDFC Bank has corrected about 10% in the recent weeks, and the ADR premium also has shrunk to more than 12-month low. As investors are a little watchful on the growth and the ROE recovery in the merged entity. And when we look at a couple of developments, this entire additional provisioning of 10,000 crore to meet the compliance requirements surely has come as a bit of a surprise, and which is why we saw that 4 to 5% kind of a knock. But I think when we look at the valuations and combine that with the possible growth that the company can deliver, see, currently it is quoting at about 2.1 times March 25 and about 2.85 times March 24 adjusted book. So this is the lowest that we have seen over a decade. And the growth in terms of loan and the profitability could be somewhere in the range of about 15% or thereabouts. So I think clearly from a risk reward point of view, this surely makes sense. Yes, it is going to remain a bit of a subdued over the next couple of quarters as we go through this integration and a bit of a slowdown. But clearly this is one of the high quality investment bets that one can really look at.
Hemang, hi. Good morning. But do you have cover? Have you looked at Voltam Transformers? The company where we are likely to see a large block. Again, the stock's done extremely well over a long period of time. Any thoughts here?
And specifically, we don't cover this one, but I think when we look at the capitals and the equipment space, the overall traction in terms of growth, order book, that continues. There is a lot of appetite. So if there is any large block which is available, and if it is at a good amount of discount, surely there is going to be a lot of appetite over there.
Okay, all right. Hemang, I want to ask you your view on cement companies as well. But for the time being, we'll just hop across to our guest who's here, and then we'll come back to you. Now, DAM Capital, they came out with a note yesterday. They believe that South Indian cement companies, they're well placed with respect to pricing, and the industry saw signs of strength with respect to pricing even in September, led by East India. To help us out with how are things on ground, Mr. Radhakrishnan, the whole-time director as well as the CEO at Kesoram Industries, joins us on the show. Hi, Mr. Radhakrishnan. Thanks so much for joining in. After that, we'll also be joined by Naveen Sahadev, who is joining in to give us his view on his top picks from the space. Thanks, gentlemen, for joining in. Well, Mr. Radhakrishnan, let me come across to you first. There is expectation that there's going to be a price increase from early October. Could you confirm that to us, late September, early October? And what could the quantum be, particularly in South India?
So, good morning, Nigel. So the way we are looking at is scaling up the prices by about 30 to 40 rupees is what we are looking at to scale the prices.
That is in the South Indian market. And what about in Maharashtra? I think you're on the west as well. You have around 50-55% exposure. So in South India, you're saying 30 to 40. In West India, how much?
Yeah. See, West will be closely about, again, anywhere between 50 rupees is what. I can speak for Kesoram. I can't speak for the industry. So far as Kesoram is concerned, this is the price hike which we are looking for. Because the cement industry, as an industry, we have been going through a tough phase after the escalation of cost. Yes, there has been some respite from last year, second half. Now, if you look at again, the pet coke and coal prices are firming up. So,
okay, Mr. Radhakrishnan,
it is important to pass on the cost.
Yeah, Mr. Radhakrishnan, just to clear out a couple of issues. First, on the pricing, you're saying 30 to 40 rupees in South India. For Kesoram Industries, that's the price increase you're pushing. And in West India, around 50 rupees. Did we get those numbers correct?
Yes.
Okay. Now, on the cost front, there was some cooling down of cost that was expected. Now, the DAM Capital note suggests that maybe 100 rupees per ton on a sequential basis. That's in Q2 in comparison to Q1. What is your estimates? The cost of production of cement could go down by how much per ton in Q2? And in the second half of the year, how much lower can it go?
So I wouldn't say there is a substantial reduction between Q1. That's not so substantial. Maybe 50 to 70 rupees is what I would see the reduction, not close to 100. And even that 50 to 70 rupees in the recent weeks is getting eaten away with the firmness of pet coke and coal. This is where we are. That's the reason we need to hike the prices.
Okay, got it. Mr. Radhakrishnan, just stay on. We have Naveen Sahadev who tracks this space very closely as well. Naveen, morning. You know, there's been a recent correction in the cement stocks. Is it now an attractive place for buyers to enter? And if yes, in your coverage universe, which are the companies that could be beneficiaries of these higher prices and perhaps where you may upgrade their EPS and earnings estimates as well?
Right. Thank you. So clearly the pricing environment is improving. So what we gathering through our multiple channel checks and speaking to various experts is that the pricing environment is certainly improving. I think the expectation is right pretty much for a substantial hike in South, similar to what we see in East. And it was only a matter of time because East is the extended market for players in South. So if that region has seen a decent recovery, there's no reason why South should be left behind. So coming to my top picks, the way the stocks have run up, I still see very good upside in Grasim Industries, so to say, because not just you get to play the cement story, but also the paint business of theirs is about to start. So that should be a good value unlocker of sorts. And in the mid-cap space, then we are looking at JK Cement as the buy recommendation we have in our space.
Okay, so you're saying Grasim and JK Cement are the stocks you like from the large and mid-cap space, and pricing is improving, especially in some of the regions like the South. Got it. I wanted to understand on the demand front, are you seeing a commensurate, improvement in demand as well? Now that the monsoon season will, be behind us, what is the prognosis over the next 3 to 4 months?
No, demand, I think nobody is really doubting. It's extremely encouraging given this is a, pre-election year. So I think anywhere between 11 to 13% can be a very good demand growth estimate. And we have seen this in the last pre-election year as well as in FY19. Demand grew 13%. So I think demand is not really a question. And to answer, it's not just one or two regions. I think in general, across all regions, the pricing environment is on the mend, or I could say definitely seen improvement.
Mr. Radhakrishnan, just one question. So, we were waiting for monsoons to get over for price hikes to kick in. That's starting to happen. But is the extreme would you reckon the extreme volatility related to input prices, etc., is kind of behind? It's a more steady cost environment. Demand, as Naveen pointed out, is going to be steady. Or it's too early to say. What's your sense, sir?
Yeah, it is a bit early to say. I could see there could be some more cost pressure on basically fuel. We need to see how it pans out.
Okay. All right, Mr. Radhakrishnan, very quickly before we let you go, you earlier given us guidance that volumes will do of 8 million ton in this year with a EBITDA per ton of 650 rupees. Do you stick to that?
Absolutely. We see a good volume demand, and Q2 is supposed to be very well. That's the way we look at it. It's going to be good demand, robust demand for the industry in Q2.
All right, you'll be in silent period, but you'll have your results, I think, in the next 2.5 weeks or so. Do we hear something with regard to the refinancing? Because as of now, you're borrowing at 18 to 19%. By the next time we chat, maybe in the next 15 to 20 days, should we hear something on that front?
Absolutely. In fact, Q2, I meant H2 is supposed to be good for the industry, and we will grow robustly in H2. That's the expectation. And refinancing, yes, I've spoken. It is on track. That's what I can say at this juncture.
We'll get more numbers from you when you join. I think your results should be in the second week of October. So at that point of time, I'll press you a little bit more for the refinancing and the debt reduction plans. But thanks so much, gentlemen, for joining in, Mr. Radhakrishnan as well as Naveen, and giving us your sense. Pricing is improving, demand is expected to be strong, and input cost will cool off. So that's about the cement space. Let's move on to trade setup. Anuj joins us to tell us how is he's reading trade today. Morning, Anuj.
Morning, Nigel. First signs of stability yesterday. The mid-cap index actually outperformed. And you had HDFC Bank, which after 4 red days, saw first green day. Though didn't manage to close at the highs of the day, but still there was some greenery. 3,200 crores of delivery buying in HDFC Bank is what you saw, 71%. Also, ICICI Bank led the recovery. So that's something to keep an eye on. It also closed at day's high. Today you have Fin Nifty's expiry. So ICICI Bank and HDFC Bank, they'll be in focus. The US bond yields, they hit 16-year high. The Nasdaq was flat, but over the last few days, you have seen some kind of decoupling of the Nasdaq and the Indian IT stock. So that's something to keep an eye on. The key levels to watch on Nifty and Bank Nifty would be yesterday's low. Now coming to Nifty first, the first support would be 19,601, which is yesterday's low. And the bigger support is 19,540, which is the 50-day exponential moving average. On the upside, the first resistance is 19,734, yesterday's high. And the bigger resistance is 19,766, which is falling 20-day exponential moving average. Now be ready to take 40 to 50 point swings, because this is not the kind of market which will give you 200, 300 point swings. That market has come and gone. For some time now, there could be some volatility. The bigger swings would come if you start to trade below 19,550 or above 19,800. On the Bank Nifty, the first support zone is 44,300 to 44,400, which is the 100-day exponential moving average, also yesterday's low. And the bigger support zone is 44,000 to 44,200 based on charts. And on the upside, the resistance are very well defined. 44,827, the 50-day exponential moving average, and 45,050, which is the 20-day exponential moving average.
All right, Anuj, thanks a lot for that. So those are all the cues as we head into a brand new day of trade. Let's take a quick break. On the other side of the break, is this market headed lower in the near term? Is there more volatility in store? Mitesh Thakkar and Sudarshan Sukhani join in for some technical trades. Stay tuned.
Welcome back. Well, the gift Nifty is suggesting that we open up on the back foot, but let's see how do you trade from here on. And to help us out with that, our technical experts, Hitesh Thakur and Sudarshan Sukhani, join us on the show. Good morning, gentlemen. Thanks so much for joining in. Well, over the last few days, we've been making lower lows. But how do you approach trade today? Hitesh, you go first. Give us your trade on the index.
Nigel, good morning. I've been saying that the markets, will be kind of sell-off rally in the near future, and I think I still maintain that negative outlook. I think getting past the levels of 19,880, 19,850 zone will be very difficult, and there are also pivots in between around 19,700. So I think on the upside, the ceiling is there in the short term, and the index might find it very difficult to get past these levels, while there's a stronger chance of us heading towards 19,400 and in the worst case scenario, 19,250 as well. So I'll be trading with negative bias on the index, and also is the fact that last 2 days we have had more sell calls on the stock side as well. It's very clearly looking at more of shorting opportunities.
So, sell bounces rather than try and buy any dips. That's basically the view coming in from Hitesh. Sudarshan is also with us. Sudarshan, would you kind of concur with that kind of view? What's the sense?
Yeah, good morning. See, I always find it difficult to go short in a correction. The markets can change tracks so quickly. So the trade is either not to do anything or to see if there is a dip and stability and then go long in it. My own sense is that this market may be finding support around 19,600, and it's therefore important to understand that if this support holds, there is a buy on dips opportunity for the day. There's no need to carry positions, but keep a very tight stop at 19,550 if you see 19,600 hold. That's a judgment that the trader has to do. But I am not looking at any short trade. The same applies to the Bank Nifty. If there is support, if after the initial decline, the Bank Nifty has some kind of a holding setup, then buy with a stop under 44,400. Both are intraday trades only on the long side.
Okay, what about individual stocks? What are we looking at this morning? Sudarshan, let me begin with you.
Okay, Bharat Forge is a buying opportunity. That stock has been an outperformer and suggests an outperformance again. Buy with a stop under 1,075. Britannia is a buy. Some possible base is being built. It doesn't actually break out, but it still does something. Buy with a stop under 4,500. Then Naukri is an intraday short. 2 days ago, it had a very big decline. And then earlier rallies have fizzled out. It's an intraday short with a stop above 4,300. And Escorts is a buy. It does suggest that some kind of an attractive breakout is in the offing. Buy Escorts with a stop under 3,100.
Okay, all right. And Mitesh, what about you?
I have more sell calls as I mentioned earlier, but there's one buy and disclaimer on that. That's a stock in my portfolio. That's Godfrey Phillips. I think after a few weeks of pullback, gave some kind of a reversal. So recommend buying this one with a stop under 2080 for trading purpose and a target of around 2240 on the upside. The rest are sell calls. Couple of pharma names on the list. Glenmark is a sell with a stop at 798 for targets of around 760 on the downside. And the other one is Sun Pharma, which I recommend selling with a stop at 1136 for targets below 1100. And a conditional sell on ICICI GI, which if it breaks the pivot of 1309, it's closed at around 1315. So if it starts trading below 1309, take a sell position with a stop at 1331 for targets of around 1270.
Okay, well, thanks very much, both of you, and we'll have you back in just a bit for more as the pre-open is upon us. Just a quick look at a few other names, and this is, of course, from yesterday. Yesterday, there was no real discernible move or sector move, maybe except sugar, which, that pack moved up. Bajaj, Dwarikesh, Balrampur, etc. They were strong through the course of the day, but apart from that, it was very scattered, really. Hemang Jani is still with us. Hemang, just a couple of names coming your way. One is MCX. A great deal of excitement. It was our story with regards to that technology platform. I don't know if you have a view. And then if you want to come in on Sundaram Finance, which has woken up over the last 3-4 days and is starting to move. It's perhaps the bluest of blue chips in terms of the NBFC space. So your thoughts? Go on.
Yeah, so MCX clearly, if they are able to successfully migrate to the TCS platform, that would be a big trigger. And as we all know that because of the extended, time that they took to really do that migration, they had to shell out, on a per quarter basis, almost about 150 crore additionally. Apart from that, on the volume side, on a month-on-month basis, we are seeing about 25-30% kind of a growth in the volumes. So I think clearly this is a great news for MCX, and though the stock has run up, I think from a scarcity premium perspective, we have only two exchanges available, BSE and MCX. So clearly, the bias for there continues to be very positive, but key monitoring will be successful migration. Coming to Sundaram Finance, I think NBFCs as a space, we are seeing a bit of attraction, though NIMs last quarter were not that great. There is a sense that from this quarter onward, you will see stability. Also, you are seeing incremental positive news coming through from some sort of interest subsidy or additional incentive coming through for housing and interest rate, etc. So those kind of news will have some rub-off on NBFCs and particularly in the housing finance ones.
We'll do one thing. We have to take a short commercial break, but we'll come back for some more ideas on individual stocks. When we come back, we'll also have the pre-opening rates, and we'll get you an exclusive conversation that we had with the ITC Chairman and Managing Director Sanjeev Puri to talk about the demerger of the hotel business and an outlook on the industry overall. Stay tuned. Welcome back to Bazaar Morning Call. Well, we're just heading to the market opening, which will kick in just a while from now. So while we wait for those rates to adjust, let's get you an exclusive conversation with the ITC Chairman and Managing Director Sanjeev Puri, who told CNBC-TV18 that the hotels business will be debt-free after the demerger is complete and will be able to fund its expansion for the next 2 to 3 years. Speaking exclusively to Shireen Bhan, Puri said he doesn't foresee significant need for raising capital in the hotels business, and the company will be increasing its footprint in Tier 2 cities and beyond. Listen in to that exclusive conversation.
Indeed, as you very rightly put, India's moment for a confluence of factors. One, of course, the economy, the macros are doing well. I think there's been a lot of good policy interventions, not just policy interventions, but you can see it on the ground, whether it's a digital infrastructure or physical infrastructure and many more. So it's really worked out well, and it's wonderful that despite the difficult global situation, Indian economy is still growing. It's growing well despite exports being under severe pressure. So indeed, things are well placed as far as India is concerned. And as you know, in the new world order, and given India's advantage of demography and the scale opportunity that India can provide, whether it's manufacturing or services, I think there's a lot of global interest to look at this as a hub, not only to deal with the growing domestic consuming market, but also as a hub for global exports. So it's a great opportunity for India, and certainly it's very positive for all the segments of ITC. Most of our segments are related to the consumption in the economy. We are a very India-focused company, and we are very confident and optimistic. Last year we commissioned 5 manufacturing facilities. Right now, 4 more are in the pipeline. When I say in the pipeline, it is not on paper. Work is actually happening on the ground. One, in fact, should be commissioned in the next 12 months itself. And we are also scaling up our hotels footprint. In the last 16 months, we opened 18 hotels. So in all the segments, we see immense amount of opportunity. We are very optimistic, and we continue to invest.
Well, let's unpack this, and this is the first time that we are speaking to you after the hotel demerger announcement. So let's understand where things currently are on track as far as the movement of shares is concerned, as far as the hotel business is concerned, and what's the outlook from here? Because you will continue to hold about 40%. Why did you feel it necessary to do so, and what's the plan now as far as investing in the hotels business is concerned from here on?
So first of all, yes, as far as the process is concerned, it's just started. So, I mean, nothing to say that, nothing much to say, it has just started. It's about a 15 months journey, and we believe it's well on track because we are well prepared for it. As far as the restructuring is concerned, I think, yeah, this 40% issue has actually generated a lot of media interest, though our shareholders were fairly complimentary in the AGM. And I had also occasion to hear the same, compliments from certain institutional investors, because this has been very well thought out. So that fundamentally we must recognize that whatever we do must position the business in a much stronger wicket than what it was before. And for that purpose, for the hotels business, first of all, to grow and thrive and to actually benefit from the tailwinds that this sector has got, it's important that it continues to enjoy the trademarks, the corporate goodwill, and all the processes and the synergy from ITC. We have huge investments in digital, which is also available for hotels. So it's important that the hotels has access to this. Similarly, for the growth of our, say for example, FMCG businesses, the foods business, I have often spoken about the power of synergy. It is also a way for us to create new growth opportunities. The cloud kitchen comes together because of hotels and the foods business, right? So we don't want to lose this value accretive opportunities when we reorganize ourselves, right? And what is happening after this is that as far as ITC is concerned, our return on our ROCE is improving by 2,000 basis points or thereabouts. Our ROIC is improving by nearly 1,000 basis points. So there is productivity or financial metrics of ITC also improve. Shareholders of ITC get a direct 60% benefit in the hotels business. And there is a determination of the price based on market mechanics. 40% is held indirectly through ITC. Yeah. The hotels business will attract the right kind of investors who are interested in that kind of business. So all in all, it's a win-win for everybody. I think 40% was required so that synergy is sustained and the operations of hotels are stabilized. It gives confidence to all the stakeholders of the hotels business, whether it's employees or other stakeholders who partner with us. And therefore, I think that 40% was definitely required.
Okay.
And as far as investment in hotels is concerned, yeah, we have a strategy which we have said is asset right. That's the course we will stay. It is different from asset light.
Yeah.
So it will be a balance between management contracts and our own properties. And this new company has a very strong balance sheet. It will be debt-free with marquee properties and a very strong balance sheet, good cash flows. And it will also, as we have said, be funded for its capex requirements for 2-3 years through liquid investments. So the capacity of this new entity to raise capital for the investments it wishes to do by way of, through its own resources or through debt is very strong. And of course, always the possibility is there to, raise through equity route also. Because it's a very strong balance sheet of this enterprise.
But, given the aspiration that you have for the hotels business as well as the growth opportunities that you foresee, what do you believe will be the capital requirement to fund those aspirations over the next 5 years? What kind of capital raising potentially could we be speaking of?
Well, I do not see the need immediately or I do not foresee any significant need for capital raising. I think the cash flows plus the liquid investments that will be provided for the 2-3 years of capital will be sufficient. Because remember that we have a very strong footprint already in most of the metros, right? And therefore the incremental investments that we will be will be in maybe tier 2 towns and so on and so forth, where the sizing is different. Sizing is different, right? So therefore, I don't see any major requirement. But if, for example, an opportunity which cannot be predicted, say an opportunity for a trophy property comes up, right, and it requires substantive investments, I'm saying the enterprise has the capacity.
Are you looking at any trophy properties today?
No, I don't know when it will come, what will come. I'm just saying, potentially, you could you have to keep your eyes and ears open.
Okay, well, that's an interesting chat with the top man at ITC. You can catch excerpts of that exclusive conversation with Sanjeev Puri all day here on CNBC-TV18. Oh, all right, so big conversations today, and there's more coming up. But it's 9:08, so let's get the calls out of the way. Sudarshan and Mitesh both are with us. Gentlemen, welcome back. Mitesh, what do you have?
I'll go with the buy on Godfrey Philip. Disclaimer, we have interest over here. It's part of my portfolio, and it's given a fresh signal yesterday. So keep a stop below 2080. Look for a target of around 2240 in the short term.
Okay, that's on Godfrey Phillips, a buy. I just wanted to take a look at some of the stocks that are moving around. Important to track what's happening with HDFC Bank, considering that, yesterday was the first signs of movement over there. So HDFC Bank in focus. Tata Steel is up almost about 1.5%. Eicher Motors is up 0.5%. We'll get to that in a bit. And a couple of other auto stocks also not doing too badly. Sudarshan is also with us. Sudarshan, what's the big call at 9:10?
Escorts is a buying opportunity with a stop under 3,100.
All right, there is something big happening in Escorts. I mean, there's been plenty of buying action there in the last many days. That stock, in fact, now well above the 32.50 mark. Thanks, gentlemen, for that. Let's get to our new segment, CNBC TV18 Stock Capsule, a segment where we focus on a buzzing stock and talk about the company's fundamentals as well, any key triggers there. Mangalam is tracking Hindustan Foods. Mangalam, over to you.
Well, it's an interesting name because, we've seen a big outperformance in that stock. But in yesterday's trading session, it was down almost 8%. And the reason for that basically was the company's, announcement of fundraising of around 400 crores via issue of warrants to non-promoters, QIBs as well as non-promoter, non-QIBs. The reason why the stock declined in yesterday's trading session was largely because the warrant price, conversion price, was much lower than its previous close. So warrants worth nearly 310 crore to non-promoter QIBs were convertible at 546 rupees per share, and worth 90 crores to non-promoters, non-qualified institutional buyers was convertible at 563.4. The previous close price of the stock was a little above 571 itself. But, that should not make people not take notice of the big move that we've seen in the stock price. 3 times in the last 3 years and 9 times in the last 5 years. What is the core business of Hindustan Foods? Their core business is to buy non-core manufacturing businesses of large players. In fact, they've bought some non-core businesses of a lot of these FMCG players, and they turn suppliers to them. They manufacture for HUL, the personal care business, F&B. They manufacture for Nykaa, Wheat, FedEx, as well as Hush Puppies and Bata. In FY17, they acquired the leather division from Hindustan Unilever. In FY19, they started manufacturing detergent, tea and coffee. Then they also acquired malted beverage productions alongside home care production. And in last year itself, they started manufacturing sports shoes, ice creams, and acquired a plant from Reckitt as well. Has that seen an improvement in their numbers? Yes. In the last 5 years, their revenues have nearly moved 5 times, from 500 crores in FY19 to around 2,600 crores in FY23, with their margins staying around 6 to 7% itself. Importantly, this is a manufacturing company, so the metric to look at is their gross block. Their asset turnover ratio is close to around 4 times, so that's a positive as well. They do have debt of 500 crores on their books. With this fundraise, perhaps that should be, alleviated. Those concerns should be alleviated. The big triggers to watch out for, them expanding into new products, focusing on scaling exports, backward integration, as well as higher margins business, which is their own personal brand business, as well as anchor tenants. They have interesting shareholders as well in the likes of Westbridge Capital and Nikhil Vora's fund, as long as his, personal investments too. And the stock trades at 63 times FY24 price to earnings.
All right, thanks a lot for that. So that's on Hindustan Foods. But let's also take a look at some of the momentumizer stocks of the day. So that's coming up in a bit. I think Rima's joining in to give us more on that. Rima, over to you.
Thanks so much for that. So IRB Infrastructure is my momentumizer stock for the day. 1, the stock rallied close to about 8%. 2, the volumes were double of what we typically see. There was a very small block deal also, but it was just to the tune of 0.16%, so no buyers or sellers were disclosed. But the more important reason is, technically, the 20-day moving crossover appeared yesterday. So the stock closed at about levels of 32, and it crossed its 20-day moving average of 30.85. And the previous closing level was below 30. So yesterday, with the up move, the stock crossed over and closed above its 20-day moving average. In the last 1 month, it's up 19%, 47% higher in the last 1 year. There was some recent news last week only where its SPV, Samma-Kiali Tollway, has achieved financial closure, and they've tied up debt of nearly 1,446 crore rupees for the project.
Okay, that's IRB Infra. You can catch the management coming up at 9:50 on Bazaar today, so don't miss out on that. The other stock that we're looking at this morning is Eicher Motors. It's up almost about 0.5% right now. Jefferies has in fact raised their target price on Eicher Motors to 4,150 rupees a share. And they say that in 2023, there was a lot of rising competitiveness across the board, and that weighed on the stock, because of which the stock underperformed the auto index. So Eicher Motors has been lagging the Nifty auto index by 24%, and hence the time is now to perhaps buy the stock. The risk reward looks favorable. Despite fresh competition, they say that channel checks suggest limited impact on the company, and it's a good time to buy because the stock price has fallen and they have alleviated all competition concerns. They also talk about how the EBITDA and the EPS of the company will rise 62% and 82% respectively over FY23 to 26. And two-wheeler demand is recovering, premiumization is picking up, exports are also picking up. So it's only a win-win situation for Eicher Motors. But there's a lot of other stocks in focus.
Berger Paints was down sharply yesterday. They say prices lead and then reasons fall. I'm not sure that is the case here, but Mangalam is here with, I think there's a downgrade on Berger. Mangalam, morning.
There is one, and this one comes in from Kotak. In fact, they say that the Berger stock price is up 9% in the past 3 months, despite yesterday's 9% fall, and as a result of which, it is trading at a mere 4% discount to Asian Paints at 54 times 2-year forward earnings. They say that, yes, Berger has outperformed Asian Paints volumes in the last 4 quarters, but that does not merit this kind of stock outperformance. And rise in crude oil prices does pose a risk to their margin estimates for this year itself. And more importantly, as the end of this financial year, we have the big launch of Grasim, they believe that Berger is more vulnerable than Asian Paints itself. And as a result of which, they've downgraded the stock to a sell with a target price of 500, which is unchanged. But just the recent outperformance of the stock price has caused them to look at it.
Okay, thanks a lot for that. So many stocks in focus, but the market takes center stage now in the next 15 seconds as we open for the day. Looks like it's going to be a pretty flat opening. That's what the the Nifty and the sensex are indicating, at least the pre-opening rates. But remember, we have a couple of headwinds which could put a lid on the market's gains, including the rising crude prices and higher FII selling. So here's the first tick on the index. It's very, very flat. 19,680 is what the Nifty is trending at. The mid-cap index is very quiet as well. The Bank Nifty continues to, exert that bit of pressure on the market. So Bank Nifty is down almost about 60-odd points. In terms of individual stocks, it's Tata Steel that's topping the charts this morning, 1% higher there. Tata Consumer Products is also in the green. Eicher Motors, we were mentioning that Jefferies is raising the target price. Eicher Motors is up about 0.5%. It's one of the top 5 Nifty gainers this morning. L&T, Maruti Suzuki, Ultratech Cement are a couple of other stocks that are trending in the green today. Some other heavyweights that are, supporting the index are names like Infosys and ICICI Bank. Both those stocks are trending in the green as we speak. So that's the list of gainers. On the losing end, you have pharma stocks. Apollo Hospitals, Divi's Labs are in the red. Some of the IT names, TCS is also trending in the red this morning. Reliance has been dragging its feet a bit. HUL is flat with a bit of a negative bias. But other than that, it's a very, very flat market. At least that's how the frontliners are panning out. I think the trade has happened on Voltamp transformers, where I think 13% equity has changed hands. So just keep an eye out on that. 12.7% equity has changed hands, and Voltamp is now down about 5.5%. We were speaking about that earlier on the show as well. More on that later, but for now, the market is very, very flat. I think it's a tug of war between the bulls and the bears. For now, the bias seems to be more on the bearish side, especially with the Bank Nifty, but we'll see its initial moments yet.
Well, in the last few days, Sonia, we've gone numerous times down to 19,600, 19,625, and we've bounced off that mark. Today as well, we saw a bit of a downtick, and that's got bought into. So let's see whether or not that holds out, given that we have expiry that plays out. Few stocks are in focus. Delta Corp continues its losing weights. It's down close to around 4.5%. Strides Pharma ended yesterday at the high point of the day. We'll have the management shortly with us. That a big deal that they announced yesterday, they're consolidating the CDMO operations. For the time being, the stock pulls back a little bit. From the broader market, Celan Exploration, I'm just looking at that one. A smaller company, they have announced the merger with the promoter entity. That's Antelopes Energy. And that's why, in fact, Celan Exploration, I think let's get that stock up. Not a very, very large company. I believe that the ratio is not yet out, but that stock, in fact, is moved higher as well. So that's one of the top movers from the broader markets. Keep an eye out on that one. Whole time the deal takes place and the stock has bounced off the low point of the day. Prashant, what else?
Well, it's absolutely flat. So 19,682 is where the index is at. So, will we have another repeat like what we had yesterday? Because yesterday, through the course of the day, there were intermittent bounces, but all of them got sold into, and we ended pretty much, very, very flat. Venus Pipes is a name which is coming up with about a 2.5%, 3% gain now. just highlighting things with volumes, large volumes. Century Textiles is coming up with a 3% gain, so keep an eye out on that one. Aisha, Sonia highlighted earlier, about 3% in the green. KEI was down yesterday. It's back up about 3.5%. There is KRBL. I think there was some sort of a one-stock kind of export which the government has allowed. I don't know, that's on the back of that, but it's up 4%. So that's KRBL. Dwarikesh is up about 1.5%. Sugar was the only kind of space which looked good as a whole. Yesterday. So we'll see if that is it repeats itself. Delta, a big correction yesterday. It's down another 5% this morning. And of course, we highlighted Voltamp was the block which is down 5% as well. 46.90 on Voltamp. But on the index level, it's very, very flat with a 10-12 point change. Our market master of the day is S. Narain, Executive Director and Chief Investment Officer at ICICI Prudential Asset Management Company. Narain, great to have you with us here. It's always a pleasure having you with us here on CNBC TV18. I was looking at your outlook report for the month of September, and you, in that, do highlight that historically, whenever global central bank balance sheets rise, equity markets do well. Right now, the balance sheets are contracting, but markets are ignoring that. Throw in the fact that you also have had additional tightening in the US, natural tightening with interest rates, market interest rates going up, yields now above 4.5%. At the margin, even compared to the end of August now, are things turning a little sort of cloudier in terms of outlook for markets? Go on.
I think that there is a structural story and there is a story because of liquidity arising out of central bank balance sheets and crude oil. I think as far as India is concerned, people are looking at the structural story and not the problems out of valuations or crude or anything like that. And that is the reason India is holding up much more than global markets at this point of time. If you see in the recent past, I think US markets have come down and many of the other markets like China and all have also come down. But India is one of the few markets holding up because of the structural story and the fact that the domestic investors have been very positive on equities. So I think these are the factors which is holding up the Indian markets despite valuations, particularly in the small and mid-cap space, increasing consistently from March till now. And that is the reason at this point of time. That's how we see it.
And is that the right way to look at it? You're saying, focus on the structural story and ignoring the other...
I think from a long-term investor point of view, our framework has been always clear that, asset allocation is what works best. So a year like 2020 is the year where you actually increase your allocation to equity significantly. And a year like 2023 is a year where you cut your allocation to small and mid caps because they've done extremely well. So asset allocation is what works very well in the long term. But the fact is that asset allocation is actually always against the trend of the moment. So in a year like 2020, if you go and tell people increase your allocation to equities, you're met with people asking you, what are you asking me to do? So this year, if you ask people to cut your allocation to small and mid cap, the same question is asked, what are you asking me to do? So I think the challenge is that if you ask people to do something like asset allocation, it is always against the trend of the moment, but it leads you to long-term returns because it leads you to a situation where in 2018, you take out money from small and mid caps, it leads you to good experience. In 2020 or 21, whether you put money in equity or small and mid caps, it leads you to a positive experience. And today, if you cut your allocation to small and mid caps, actually, it is against the trend of the moment. So what the promoters are doing today is they are taking out their positions in small and mid caps. So every week, you will have at least one promoter cutting their allocation to small and mid caps by cutting their own promoter holdings. And you see many of the private equities also cutting their holdings in small and mid caps. So that's what is happening at this point of time. That is where we are, whereas the large caps have done much worse than the small and mid caps at this point.
Sure. By the way, I just want to mention the biggest Nifty gainer now is Eicher Motors. It's surging as we speak. It's up almost 3.5–4% now in big volumes. As we were telling you, Jefferies has raised their target price to Eicher Motors. It's a big upgrade. I mean, the target price now stands at 4,150, which is a big upside to the current market price. Naren, I wanted your thoughts on what's happening here in the auto space, right? There are many tailwinds right now across the board, whether it's a pickup in demand, a fall in raw material prices. There's this big wave of both premiumization and electrification of vehicles. Do you think the time is ripe to put fresh money to work in this sector? And do you expect a multi-year upcycle here?
See, actually, we launched the Transportation and Logistics Fund a year and a half back, or just over a year back. And I think that timing was actually turned out to be extremely attractive for investors. As we speak, the valuations have expanded in some segments of the market. And we do think, if India is to grow over the course of the next decade, you're not going to grow without auto sector doing well. And we are selectively very positive on auto. So if you look at, for example, our Flexi Cap Fund, you can see a meaningful overweight in the auto sector in specific stocks. So we are positive on specific areas in auto. But having said that, you're not going to have a one-way uptick in the sector, because there are disruptions in various ways in the sector because arising out of technology changes and various elements. And, we have had a situation where for the last 7-8 years, there has been no growth in the two-wheeler industry. And so you are going to get some cyclical benefits also, hopefully, in the next 4-5 years in the two-wheeler industry. So it's a very interesting sector where a lot of bottom-up work can be done, because there have been stocks which have done badly. There are stocks which have done well. There are auto ancillaries which are very competitive in the global space, and which have actually got technology leadership and market leadership over a period of time. There are specific auto ancillaries which are slowly not doing well, which were all actually, which are supposed to be moated companies 5-6 years back, where the moats have changed because the IC engine is no longer the key at this point of time. So it's a very, very interesting sector for the long term.
Hi, Naren. Good morning. Good to hear your thoughts as always. Nigel on this side. Naren, I wanted to ask you about the banking space, because that's poised very, very interestingly, right? The PSU banking space, the way that's re-rated, wow, that's played out very, very well. But as of today, maybe valuations not as attractive as they were, say, a year or so ago. How do you position yourself now when you're approaching the banking space? Because there are a couple of large banks out there, HDFC Bank, Kotak Mahindra Bank, they've been underperformers. Will you allocate money more towards private, or do you still think there's a case for re-rating in the PSU banks?
I think the re-rating in PSU banks has been significant, and today many of the private banks have actually underperformed the PSU banks in a very, very significant way. And no one would have believed it 3 years back that the PSU banks can outperform the private banks in such a significant way. So, as people who believe in cycles and contrarianism, today we would definitely bet on private banks over PSU banks, because the level of outperformance, if you see in PSU banks over private banks, has been very, very significant in the last 3 years. And it has happened because of over-ownership 3 years back. 3 years back, if you had told people you should invest in PSU banks, people said, no, I won't invest. But today, if you look at it, the over-ownership in private banks 3 years back has led to significant underperformance in that area. And therefore, today, I think private banks looks like a good contrarian bet at this point of time. Because what is holding back that area is actually over-ownership rather than anything really fundamental at this point of time. They are growing well. There are no NPL issues. The credit growth has been good. And from a technology and entire customer perspective, I don't think they're doing badly at this point of time. It is just the over-ownership which is holding them back. So we think they're good for the long term.
Heated debate around the big name there in the private bank space, HDFC Bank. You're clear in your mind that this is a good time to buy it?
See, we don't talk on individual stocks, but I believe, in a way, you have to look at what is the long-term intrinsic value of any stock and look at the share price. And if people get into fear mode in good stocks, which happened in 2020 in metals, telecom, power, we used that opportunity very significantly, and even PSUs at that point of time. So at different points of time, you have to use different areas. Today, slowly in 2023-24, it looks like some of the mega caps are becoming the biggest underperformers at this point of time. So we have to look at the mega caps and see whether they are relatively much better positioned for the next 3 years compared to the micro caps and the small caps at this point of time. So we have to do that analysis. If we see better upside on a risk-adjusted basis, we will look at them, and that is how we do this analysis.
Just a few more questions, Naren. The consumption space, I mean, it's actually quite a strange dichotomy because the consumption space is hurting, all right? I'm talking about lower and middle level consumption even. And some are pointing out that maybe even at the premium end, things are starting to slow down a little bit. On the other hand, government infrastructure spending remains very strong, so it remains very robust. Can it continue? I mean, both of these pulling in different directions. And what are investment implications then?
I think some of the consumption sectors and particularly some of the discretionary sectors have huge implied growth assumptions even today in the stocks. That there are challenges in the stocks because of the implied growth assumptions in those stocks. Whereas, for 5 years in this channel, we've told people we are underweight consumer staples. And I always used to wonder when will it be I'll be able to tell in a channel that actually it has worked. So today we were doing our sector meeting and we found at a surprise that on a 5-year basis now, most of the consumer staple stocks have actually underperformed meaningfully on a 5-year basis. So I think, for 5 years we have been telling in this channel and now at least it has worked. So I think now we can start looking at it and see whether there is scope to look at them, because once you have 5-year underperformance in our framework, we start thinking whether there is scope to actually look at the sector or not to look at the sector. And I think that started at this point of time. On the other hand, it was an interesting sector to buy, but now those stocks have done extremely well. That actually on a long-term basis, many of those stocks have actually done extremely well.
No, my limited point was that in your, 2.5 decade career, I'm sure you would have got several opportunities to say that almost all sectors are doing well, right? Such are the cycles that at some point in time, even the laggards start to perform. And I think 2023 is that kind of year, right, Naren, where the laggards of the last decade have started to perform, whether it's capital goods, manufacturing, power, renewables, defense, sugar. These are spaces that have done nothing for investors for very long. So from these laggards, if you had to pick 2 or 3 spaces where there is a long-term upcycle in place, which ones would they be?
No, actually, I think this year is a year where we have to tell people that there is some opportunity in mega cap stocks also, and not only in micro cap stocks. I think that is a bigger challenge this year to explain to people. It is not that it is that small cap and micro cap stocks carry risks. And to explain that to people has been such a challenge at this point of time. So across sectors today, so if you look even at financials, people would think that financials have not done well because some of the banks have not gone anywhere, some of the large banks. But if you look at many of the smaller financials, they've just gone berserk actually. They've gone up substantially. So this year has been a year to explain to people that there are risks in small cap, there are risks in micro cap has been the challenge. So one of the learnings of being in ICICI mutual fund over a long period of time, at all points of time, you're trying to explain to people there are risks here, there are lesser risks here, there are opportunities here, there are lesser opportunities here. Don't go after past performance in one stock or one sector. These are continuous challenges that we keep having. And that is what we try to share with our investors. And that is the reason finally what happens is categories like hybrid, which are go anywhere kind of sectors and take lesser risks kind of things are the ones which we are able to tell people to invest in most of the time.
Okay, all right. Naren, final question from my end then. This real estate theme suddenly has come back after many, many years. Do you think that, that it's sustainable? Do you all have exposure to direct real estate? Or, I think in your fund, you'll have some of those cement names, which could be an ancillary of sort. some mid-sized companies, large-sized companies as well. So how do you play this real estate theme?
I think within real estate, the most contrarian idea at this point of time is actually REITs. If you look at REITs, some of the REITs have done so badly. It is as though real estate will go up, but REITs will keep going down. And REITs are completed buildings. And yes, there are some challenges because of some SEZ rules, etc. But in the long run, we are very confident that the government will enact rational rules. But it is amazing how people are so positive on real estate, but on a continuing basis, REITs have been falling at this point of time. So the most contrarian opportunity has been in REITs, but it is not as if cement or select real estate stocks or even select housing finance stocks are not bad ideas. But I think the most contrarian idea at this point of time is REITs.
Any other contrarian bets at this point? Just a final question, Naren. We've spoken about utilities in the past. That was contrarian back then when we spoke about it. Maybe a little mainstream now. You spoke about pharma as a space the last time you were on the program. Go on.
But some of them have done very well. Both utilities and pharma has done very well. That we are left right now only recommending multi-asset and REITs kind of things at this point of time. Because we are talking when we are close to all-time high in large cap and at almost all-time high in small and mid cap. So we have this challenge that today we have to recommend something if we think about it. And I would say mega cap against micro cap on a risk-adjusted basis is something which is looking more interesting at this point of time from a contrarian hat.
Okay, all right, Naren, it was great speaking with you. Thanks a lot for joining in. Lots to learn every time you join us on the channel, and thanks for taking the time.
Thank you for giving the opportunity. Thank you for giving me.
Always a pleasure and honor. Thanks a lot, Naren, for joining in. Well, that's the word on the market. But we're not done with exclusive conversations just yet. We had another one coming in with a market expert, Mikso Das, who is the Asia Equity Strategist at JP Morgan, joins us now from the sidelines of the JP Morgan India Investor Summit 2023 to get us some more, market talk. Mikso, thanks a lot for being with us on the channel. And this is a great time to be talking about how to approach global markets, right? Considering that it's a time when there's higher rates for longer, there are higher crude prices, there is foreign investor selling that has picked up in a market like India. Valuations are not looking that cheap anymore. How are you approaching India in the context of Asian equities?
Yeah, I think all the challenges that you outlined here, right, for the Indian market are really outside of India. And the biggest one right now is what's going to happen to US equities, which really look quite fragile in the context of the next 2 to 3 months. Given the rise that we've seen in bond yields and the bond volatility has been picking up, that typically tends to spill over into equity volatility. We've seen some of that in the last 2 or 3 days. And this could easily go on for several weeks to months, and we could see some downside in a global equity framework, and that would spill over into India and all markets globally. The other thing that's happening is that the dollar has been strengthening, and that typically tends to pressure emerging markets and Asian equities. India is slightly better off here because the dollar strength that we've seen so far this year has been mostly driven by rate differentials. And India stands out pretty well or okay on that front, so the pressure has been lesser. And the third thing that's been happening, and we think that will happen in the next couple of months, is that China seems to be recovering a bit. And so this flow rotation that you're seeing is in anticipation of that, where September is the first month we are seeing outflows from India since February. And we would expect that this continues in the near term as China recovers. Historically, the correlation between flows into China and India have been very negative. And so this sort of fluctuations is probably natural. The big picture thing, though, is that fluctuations are normal, and you have to live through volatility and periods of volatile markets. But the long-term outlook, as you can see in the JP Morgan India Summit, where we have over 600 investors across asset classes attending here, the outlook remains quite strong for the market.
So is that your base case, Mikso, that money moves out of India and into markets like China because of the rationale that you just mentioned? And is that the outcome expected over the next 1 to 2 years, perhaps? Or is that a more near-term outlook for you?
That's a very near-term outlook, I would say. So this is something that I would expect happening over the next 1 to 2 months. rather than 1 to 2 years. I think on a 1 to 2 year time frame, you will still continue to get significant inflows into Indian market. In fact, even step back further from that, right? Is the ambition really to be the most preferred market, emerging market in 2023? I think that's kind of a given. India really needs to be thinking more bigger picture, more longer term, and try to improve its development across, infrastructure, but also technology and markets and geopolitics. And all of that can happen. The opportunity set is definitely there. The setup is definitely there. So on a multi-year basis, I would think that there's a lot more capital to be coming into India. Keep in mind that the cost of capital, which has historically been a big hurdle for markets like India, has been coming down. This is partly a factor of the current account deficits going down. This is partly a factor of the more and more trade being done in INR. This is also reflected in India's inclusion in the JP Morgan Global Bond Index, which will bring some sticky inflows into the market as well. So put all of those things together, the capital challenge is incrementally being solved. So there's a lot more that can be done on a multi-year basis. When you think about markets, I would say that the biggest challenge for investors really is that there isn't enough stocks to buy. And I would expect that over the next few years, there will be a lot more capital activity. In fact, JP Morgan, even in 2023, has already been involved in 15 equity transactions. And there's a lot more companies that are thinking about IPOs in the next couple of years.
Absolutely. There's no debate that investing in the markets with a long-term perspective is generally the most prudent thing to do. But in the very near term, we have a big event upon us, right? There is, of course, the general elections coming up. And stock market investing ahead of general elections tends to be a bit tricky. In your assessment as a global investor or global strategist, how are you approaching this big event and what is the prognosis from an equity standpoint?
Right. So there's a couple of things to keep in mind, right? Like, first of all, if you look at the historical example, then it's actually quite positive, right? The Indian market tends to be up like approximately 13% in the 6 months heading into elections. So that's a good starting point. The second thing to keep in mind is that equity elections tend to be heading into elections tends to be a good time in terms of fiscal policy expansion. And if you see more of that, then that should be actually positive for the consumer sectors. And the third thing is that the elections generally tend to be more of a volatility event if the outcome is extremely uncertain. We're still quite some distance away from the actual elections, but if it looks like the outcome is not going to be very uncertain, then markets can probably handle that sort of volatility.
Hi, Mixo. Good morning, Nigel on this side. Given that China is unlocking, the commodity space could do better. What's your thoughts on that front?
Yeah, we are already seeing quite a significant rally in the commodity space, right? Like particularly in the oils. And that's mostly so far a function of supply shortage. Demand from China has not really been very strong. And we don't expect that the stabilization in the economy in China that we are expecting, it's probably not going to be significantly led by investments and increased demand for commodities and metals. That having said, given where expectations were, you could probably see some support in the commodity space, and that will continue to drive commodity prices higher. But really, from a energy perspective, particularly, the bigger picture or the bigger structural upside driver is really on the supply side, where this combination of a lack of capital investments in these spaces has left the supply side quite lagging. And as demand slows down, but it's slowing down only gradually, supply is falling off faster, and that leads to an ever-expanding supply-demand gap.
On a valuation perspective, is there more headroom for the Indian markets? I know your outlook for the Indian markets in the medium term is quite strong because of the fundamental improvement, but how are the valuations stacked up now?
So if you look at a trend-adjusted forward PE, which is how we tend to look at market valuations, in India, it's about 21 to 22 times right now. And that's definitely on the higher end. It's about 1.5 standard deviations above its long-term average. But that doesn't necessarily mean that the market has to pull back from here. Keep in mind two things. That firstly, that this valuation is being supported by earnings growth. If anything, India's earnings growth, which looked like it was slowing down late last year, has reaccelerated this year. So if you look at the forward EPS in India, it's been turning up in the last 2 or 3 months. And if this trend continues, which we have a lot of reasons to think it should, then this earnings growth will kind of offset the valuation richness that you see. So on a price to earnings to growth basis, the market looks quite middling in terms of the valuations that you're receiving right now. The second point here is that if the market really delivers on long-term growth and if investors buy into that story, there's no reason that the market can't trade in the 30s and 40 times PEs, as we have historically seen some markets do when they become supermarket darlings. So there is no upside ceiling on the Indian equity market valuations at, say, 22 or 23 times. So that's something that to keep in mind.
Before we let you go, just some thoughts on how to approach the Indian markets from a sectoral standpoint, because up until now, there has been a little bit of underperformance that the banks are seeing, especially some of these larger banks like HDFC Bank, could be because of bank-specific issues like the merger, impact, etc. But give and take everything, the two large pockets, banks and IT, which ones do you prefer with a 12-month horizon, and how are you approaching it sectorally now?
I think your conversation with Naren in the previous segment has a lot more material on that. But what I would say is that from our perspective, the banks and the financial space overall definitely looks the most attractive from a valuation perspective. The only issue is that investors are already massively overweight the banks. So this is something that you need to kind of balance out. So on a relative performance basis, we probably still would continue to prefer the bank space. IT is something that we've been a little bit cautious about given what was happening with ChatGPT and AI, but it increasingly looks like with investor conversations that many of these Indian IT firms may not be as big losers from the AI wave as it was previously being thought. So that space is relatively less preferred compared to the banks. But like I said, in a market that's going up on a 12-month basis, all sectors will probably end up higher.
All right, Mixer, thanks so much for stopping by and filling us in with your views on the Indian markets as well as global equities. Wishing you a good day ahead. Well, for the time being, though, we'll slip into a short break. But on the other side, we'll focus on Strides Pharma. Remember, late last afternoon, they announced that entire restructuring exercise with focus on the CDMO space. We'll get chatting with Mr. Arun Kumar, the MD and Group CEO. Welcome back. Well, the board of Strides Pharma, they approved a scheme of arrangement among Strides Pharma Science and Steady Science Specialties, as well as Stelis Biopharma. Mr. Arun Kumar, the Managing Director and Group Chief Executive Officer at Strides Pharma Science, joins us on the show. Hi, Mr. Kumar. Good morning. Thanks so much for joining in. Well, you put out a pretty elaborate presentation. You had a con call as well, but a few details that I would request you for. One is, when do we see this?
Thank you for having me. Yeah.
When do we see this entity getting listed? Point number one, give us a timeline out there. And the second point is, since you've cleaned it out now and you have a CDMO business, a focus on that, will you be looking at any kind of capital infusion into this entity?
So this is an NCLT process, considering that it is a fairly complex merger and demerger between companies. It takes between 12 to 15 months at the outer for this to be converted into shares in the hands of the shareholders. On your second point concerning capital infusion, at this time we have no plans that this division requires any incremental cash to grow. So at this time there's no fundraising plans in this division.
Okay, there's no fundraising plans in this division, got that. But can you tell us, in terms of a timeline, what did you say the proposed timeline was?
12 to 15 months.
All right, got that. Can you tell us what is the guidance as far as, I think, okay, Ekta is also joining in, so I'll let her take over and then I'll come back with my questions. Ekta, over to you.
Hi, Mr. Kumar. Just a quick question. One of the key things is how exactly is Strides the listed entity which will have the ex-CDMO business or, benefit from this entire deal? What is the value unlocking for them, according to you?
So clearly, the specialties division CDMO has got three parts. One is the soft gelatins business from Strides. This has been unlocked at 17 times EV/EBITDA when Strides is trading sub 10 times EV/EBITDA. So that's automatically a significant uptick in the valuation. That goes to 100% of that goes to all shareholders of Strides. Second, there aren't many specialty CDMO companies globally. There are very few companies which offer the full services that we do. We can only name 2 or 3 of them. So we think that having a differentiated CDMO business allows a very different stream of capital investors to have the option to be invested in both the companies. At the same time, existing shareholders of Strides get the benefit of playing the upsides of both the platforms.
Well, Mr. Kumar, I just wanted to know what the consolidated CDMO business is going to look like, because you're extremely bullish in terms of the guidance, $200 million in FY25, and you expect that to double in less than 3 to 4 years. What is it that we can expect in the CDMO business in terms of an order book, opportunities? Because you have mentioned GLP-1 as well as a significant opportunity for you all. What is driving this growth in the CDMO business, and what can we say would be a 5-year revenue outlook for this business?
So clearly, we are sticking our neck out with our guidance. So we will double our revenues from 200 million in FY25 in 3 years thereafter. And this is mainly because as a CDMO, Ekta, you will understand and appreciate that when we speak about numbers, we obviously are already contracted. The time it takes from customers signing up a product and the product getting approved is about three odd years. We do not take 100% of our customer forecast because it's a function of market. And yet, if we discount our book, we are very confident of, as we speak, in Stelis alone, in drug product combinations, of having an order book in excess of $500 odd million. So that will play through, and considering that we have a good track record on compliance and our partners are marquee customers here, we're very confident of them succeeding as much as we would consequently. We don't see any challenges. You know that I'm a little wary about guiding the business long term, but this is more a structured, contracted business, and that is why I'm very confident about the numbers that we have put out, and we are very comfortable delivering those numbers.
So, Mr. Kumar, you said you'll double your revenues from $200 million in FY25 in 3 years, right? So they are looking at what, $400 million by FY28, is it? That's the number?
With an increase, exactly, and you're right. And with an increased EBITDA of between 35 to 40%, that is mainly because of the biologics CDMO generating a very significantly different gross margin profile.
Okay. Increase EBITDA of 30 to 40% and $400 million revenue by FY28. Can you also give us some visibility on the debt? Because Stelis had sold their plant to Syngene for over 700 crores, which I think would be used to retire debt. So can you tell us what's the consolidated debt on the books, how much will be repaid over the next 12 months, and what's the eventual target?
So Stelis, on a standalone basis, the debt is reduced from 1,400 and it will be sub 350 odd crores post the Syngene transaction. Consolidated with all the 3 assets, the total working capital and long-term debt in the company will be less than 1,000 crores. And that reflects a debt to EBITDA of under 2.25 to almost 2 times. So we are very comfortable now with this situation to be in. Both companies have addressed the balance sheet challenges post-COVID, and both companies are performing to its past historical Strides CAGR of growth. So yes, it is a very comfortable situation to be in after several quarters of struggle when we brought the ship back to calmer waters.
All right, Mr. Kumar, for 2025, the current Strides business, that's ex the CDMO business, will do an EBIT of at least 750 crores?
Yeah, so what we also mentioned in our release is that we will recoup all the revenues lost, which is 500 crores, and the 150 crores of EBITDA, which moves into one source. We will recoup all of this in the next financial year itself. And that's based on very strong pipeline of product launches. As you probably know, we have over 150 products that are not launched in the US, which are not part of one source. And we have a strong visibility of at least 60 product launches. Our momentum of product approvals have increased significantly in the recent past, and we think that will continue, and including products that we acquired from Endo with the facility in New York. So all of that is adding to momentum, and we're very confident to guide that the next year, the revenue and EBITDA loss will be completely recouped.
Okay, well, thanks a lot for joining in. Appreciate your time here on CNBC TV18. So the listing of the new entity in the next 12 to 15 months, $400 million revenue by FY28 and an increased EBITDA of 30 to 40%. Debt is also going to go down quite a bit. But let's focus on the infrastructure space now. According to CLSA, the government has championed a capex-led post-COVID recovery, but on-ground capex momentum needs sustenance for multiplier effect ahead of the central elections. We're joined by the management of IRB Infra. Antique is quite bullish on the stock, and it is in the top pick. It is their top pick in the road space. Anil Yadav, who's the director, investor relations, and former group chief financial officer at IRB Infra, joins us now to talk more about that. Anil, thanks a lot for joining in. You know, before I ask you about IRB Infra particularly, I just wanted to understand what is the trends like on ground. Have we seen a revival in the capex cycle? And in the run-up to the general elections, generally, how does demand, spending shape up?
So I think first I will take on order award, and this year we have witnessed a very lower award so far. And this year being a general election year, probably whatever needs to be awarded will be awarded by February. I think we have still 4 or 5 months to where the project will get awarded. And there what we are seeing, there is a shift in terms of award activity, in terms of the mode of award. And we believe that there will be a significantly increase in the BOT award. And by this year end, I think NHAI should be able to award additionally 3,000 kilometers. Out of that, 40 to 45% will be BOT. And we will be eyeing for BOT, TOT, and HAM project in the same order of the preference.
All right. Hi, Mr. Yadav. Good morning. You know, I'm looking at it in terms of the near term. You know, it could be close to around 800 kilometers odd, and nearly 600 kilometers actually will be BOT, which is a big change, you know, in the near term at least, if you look at the demand that's like to come out. Who all are geared for BOT projects?
So I think BOT, we will be one of the player. And if you look at in the past, we have seen around 4 to 5 players coming and bidding for the BOT project. So I think there will be enough player for the BOT project as far as award is concerned. You have rightly mentioned that out of the near term, out of the 800 kilometers, roughly 600 will be on BOT basis.
Okay. All right. You know, Mr. Yadav, just one more quick question. GIC, well, they are the private InvIT partner, and they'll invest close to 49% in all projects. So is IRB at a competitive edge over other players who will have to invest the full equity?
Yes, so if you look at the balance sheet of the IRB, we used to have a consolidated debt to equity around 2.25 to 1. And in past back, if I compare past 2 years, that debt equity has come down less than 1:1. We have a lean balance sheet to capture this growth opportunity. Further, we have a financial partner, GIC affiliates, where in the BOT project, we have stated object that we will explore the opportunity together. And equity contribution, as you rightly mentioned, our equity contribution will come down to 51%. 49% will be participated by GIC.
Okay, all right. That's on the InvIT. I wanted your thoughts once again on the order pipeline. Just can you give us the numbers? What is the bidding pipeline currently? And for the rest of FY24, what is the order visibility or the pipeline looking like? What's the quantum?
So I think in terms of pipeline, roughly 3,000 kilometers, which will be expected to be get awarded in this financial year. That will be the additional award. Out of that, 40 to 45% will be on BOT and balance will be EPC and HAM. And as far as IRB is concerned, we have a 33,500 crores of order book already in hand. Out of that, roughly 12,000 crores is the executable order book in hand. 12,000 crores translates 3x of the construction revenue for FY23.
Is it true that there's been a big slowdown in ordering activity? I mean, I understand that the Ministry of Roads has spent about 40% of its budgeted estimate till Q1. But in Q2, how has it panned out? And do you expect to see the pre-election spending pick up closer to the general election date?
I think if you talk about overall award of last year, that was close to 6,000 kilometers. We may not reach there, but still they are talking about roughly 3,000 kilometers to be awarded in next 4 or 5 months, because post that there will be a code of conduct because of the general election. So I think there will be good number of projects available. And now considering the financials of the NHAI, and there is a tab on their borrowing, I think there will be more private participation. Hence, we are seeing that the BOT pie has increased 40 to 45%.
Indeed, and that's why you have that competitive advantage as well, Mr. Yadav. That's what most brokerage notes are mentioning. Final question before we let you go. What's the situation with that 3,600 crore arbitration in the Ahmedabad, Vadodara and Yedeshi, Aurangabad? When do we expect resolution? When you spoke to us the last time around, say a couple of months ago, you said maybe in the next 3 to 4 months we could see a resolution. What do you think now?
I think the arbitration claim, which is close to 3,600 crores, there we have guided a period of 1 to 2 years to receive the entire amount of 3,600, which pertains to various projects. And apart from that, we have arbitration going on in Ahmedabad, Vadodara. There we expect a resolution before the end of this financial year.
Okay. All right. We'll leave it at that. Thanks a lot, Mr. Yadav, for joining in and giving us an update on the business, on how the the bidding is taking place in terms of awards and what the way forward could look like. Let's move on now to our special segment, Charting Trends. Mitesh Thakkar is joining in to discuss which way the market is headed, his top stock ideas as well. Mitesh, just give us an overall, sort of synopsis of how things could progress from here. This has largely been a sell-on rally market in the last, say, fortnight or so. Do you think that is the trend that can continue?
Yeah, so, good morning, Sonia. My sense is that in the bigger picture, this looks like in case it pans out negatively and we break below 19,200, this will still be a correction. The long-term charts are very firm, but I think with the rally which we saw from March of 23, lows were around 16,800, and then we made a high of around 20,222. I think this entire movement might pan out as a corrective movement. In case we hold 19,200, it will be more of a time-wise correction, and we will see, a good few weeks now being spent into 19,200, 20,200 kind of a range. In case we break 19,200, then I think it will be some way, it will do some price-wise damage as well. But broadly, I still don't expect the markets to break below the 200-day average on a long-term chart basis, which is closer to now 18,600. So I think that should be the worst case scenario in the next few months. Given that fact, I think once this correction or this time-wise sideways activity is over, then I think we should resume another uptrend and we should make fresh highs. So overall very positive, but the next couple of weeks, maybe to a certain extent, 2 to 2.5 months, could be slightly challenging.
Okay, all right. Mitesh, what about a couple of stocks? Bajaj Finance as well as Balrampur Chini. Balrampur Chini was strong even in a weak market. How are you plotting both of them on the chart?
So both of them look very interesting to me, Nigel. Bajaj Finance, I think the key fact here is that we saw the stock break above that line which was joining all the weekly tops starting from 2021 October. So if you actually were to look at that chart, There are about 5 or 6 weekly highs on that trend line. And with yesterday's movement, and while we are in the middle of the week right now, my sense is that the way the momentum indicators are positioned, we'll have a breakout above this level of 7600, 7650. So, assuming that, I think this breakout should yield some kind of a upside target, which would be in the range of about 8500 to begin with. And extensions of those targets could be around 8800, or in the best case scenario, even 9000. So, very, very positive over here. I would recommend accumulating the stock at current levels slowly. In case you get a pullback to 7650, best levels to enter, you can enter aggressively over there and keep a stop loss below about 7440. And the targets, as I said, would be 8500, 8800, or even 9000. Coming to Balrampur Chini, I think that sugar space looks in a very sweet spot. I have picked up a Balrampur Chini. What it did was gave a breakout a couple of weeks back. Last week was a pullback, and yesterday restarted the movement on the upside. I am looking at a target of around 500 to 520, which is roughly about 20% upside from current levels. And the stock now is very unlikely to break below 410. So traders can start buying now, add more on declines to about levels of 425, 420, keep a stop below 410, and there are higher chances of the stock heading towards 500 to about 520 levels in the next 2 to 3 months.
All right. Some more stock ideas that you have. How are the other charts looking, if you can take us through them?
So I have 2 more ideas on the buying side and 1 on the selling side. Dwarakesh, again, another sugar stock. Disclaimer, it's a part of my portfolio as well. Is on the verge of breaking out. There has been a breakout which we've observed on the indicator charts. The price action should follow. So this I would recommend accumulating with a stop below 97. The CMB is around 105, 106. And I'm looking at a near-term target of 120, 125, which is a few weeks, and a positional target of around 140, which is about 3 to 4 months from here. So it gives you a reasonable risk-reward equation. Then I have a buy on India real estate. And, after a long time, this stock has come on the charts when the medium to longer term charts are now showing positive traction. So this is a buy with a stop below 72. The idea to buy this stock should be to buy now and add more around the levels of 80 to about 78. And the long-term signal, which are now pointing on the upside, gives you targets of roughly around 108 to begin with. Even 120 is a good possibility. And one sell call, or one exit call rather, is on HUL. So if you look at the monthly charts of HUL, in the last 1.5 to 2 years, we have seen multiple monthly closing highs around the levels of 2700. And now the momentum indicators have given a breakdown, which means that price should also go through some kind of a correction. One. Secondly, it will be a big underperformer in the near future. So in that sense, it should be an exit. While I'm not looking at a very big decline price-wise, but it will not participate on the upside, and therefore, do nothing good for the portfolio for the next 12 to 15 months. I'm looking at a target of around 2400, which is not very far away from here, but in a logical scenario, 2200 is what I expect the stock to hit.
Okay, all right. Thanks a lot, Mitesh, for joining in and explaining the charts to us. Let's slip into a quick break. Up next, we'll put focus on the commodity markets with Manisha Gupta. Do stay tuned in for that. Welcome back. Shifting focus to the commodity markets now. Manisha Gupta is joining in. Manisha, what's the one commodity that you're tracking today?
Well, I'm looking at copper and steel, and we have seen prices of both of these decline yet again in the markets today. You know, we did see prices try to rise in the month of September, but we have been far away from those January highs, and we have seen some more decline come in for many of these. So September, October are basically high seasonal period for construction and manufacturing, but we have seen those numbers kind of gain in the month of August, but they still are down year-on-year basis, and September numbers have continued to be on the weaker side. So it is about weak Chinese demand, and that can clearly be seen in case of inventories, because when you look at the LME inventories for copper, they have gained up by 200% in the month of July itself, and we are almost nudging around that 170,000 tons for LME. We also have seen inventories gain up in Shanghai and in case of New York as well. Well, apart from that, the US dollar index trading at a 10-month highs. We have seen all other Asian currencies kind of decline. Euro is trading at around 6-month lows as well. So that in turn also seems to be weighing onto many of these metal prices. Another important thing is that China TCRC, which is the treatment and refining charges, they are now at a 6-year high, is how they have been fixed for the fourth quarter. Now, you know, the way to look at this is that when you have ample supply of concentrate into the market, then you see the TCRC prices rise. If there is a contraction, then you see the prices decline. So this is another clear indication with the TCRC prices for the fourth quarter also at a 6-year high tells you that the supply is going to be on the higher side here. And then the production has been increasing in Chile. The earlier estimates clearly have been broken, and we are looking at higher production here as well. The global concentrate market, this is an important number to watch. That also is expected to see surplus in 2023 and 24 as well. So that means there is copper in abundance for this year and next. Until you see that energy transition demand come in or the Chinese data start to pick up and that demand continue to come in, you are perhaps looking at some consolidation, even some declines coming in for the copper prices. That's exactly what you have seen for the ferrous metals. Yesterday was a better day, but today we're back again into the negative. So if you look at iron ore prices, we're trading at a 2-week lows. Steel prices trading at a 4-week lows as well. And there was this Wall Street Association report that came in yesterday, which says that steel output in the month of August has seen a jump up yet again. And these are the top 5 countries which produce steel. And as you can see, barring Japan, we've seen increase in steel production from all other countries, including India as well, where 17% of a jump is what we've seen in the month of August. This is an year-on-year change here as well. An interesting report from Moody's also came in the last night, which says that India's consumption in sense of steel is expected to gain up by 7% CAGR until 2030. So while India consumption look good, China does not so much. And with the production on the higher side, markets are still trying to find the balance here.
Okay, all right. Thanks a lot, Manisha, for that. Well, that's the commodity corner. Let's sip into a quick break. On the other side, our special segment, it's the economy. Lata will get chatting with Neelkanth Mishra of Axis Bank to talk about how stock markets will react to India's inclusion in JP Morgan's emerging market debt index, and will the favorable macro environment continue. Stay tuned.